talk about the adjusted EBITDA is something which is not yet defined by SEBI or the Companies Act, but still many companies tend to use it. So basically, the adjusted EBITDA tends to adjust your basic EBITDA against fluctuating or the volatile one-time adjustments which have been done, which might be deflating or inflating your EBITDA. So for example, if you talk about the one-time adjustments, there can be some goodwill impairment, like there can be some gain or loss on the asset disposal, there can be some litigation expenses, there can be some gain and loss upon the FX, right? The FX trading or the FX hedging. So basically all these items can temporarily inflate or deflate your EBITDA because all these items are non-recurring items, and the impact of these items will be just maybe once in 2 years, like once in 5 years per se, and won't be happening every year or every quarter or per se every month. So basically what happens, all kind of one-time expenses, we tend to add them back because those expenses are trying to deflate your EBITDA, and all those kind of incomes which are inflating our EBITDA, we tend to subtract that. So all those kinds of goodwill impairment, we talk about right, the loss in the asset disposal, some kind of litigation expenses, there can be some kind of the loss in the FX. So all these things can be added back. And if we talk about the revenues, there can be some gain on the sale of assets, there can be some FX gain, right? So all these things need to be subtracted to make the EBITDA much more reasonable. But what do many companies tend to do in the market as of now is they tend to adjust this number against other items as well, which might be reducing the value of the EBITDA, because many of the new age companies or the startup companies, they want to make themselves at least EBITDA positive as soon as possible. So many of these new age companies or startup companies tend to quote a number as adjusted EBITDA. So for example, if rent is a major expense for many companies, and if the component of rent is minimizing your EBITDA, or that expense is a higher number versus the EBITDA, in that case EBITDA might be negative. So what do many companies do? They find something as an adjusted EBITDA R, earning before interest, tax, depreciation, amortization and rent, and that is something which is completely incorrect. Many of the companies have done that. One of the largest quick commerce company has done that in the previous balance sheets, in the previous annual reports a year back. So adjusted EBITDA can also be very manipulative. Companies can exclude the impact of those expenses which can make your EBITDA negative. EBITDA is defined by SEBI, is defined by the Companies Act, but adjusted EBITDA is something which is not yet defined. Some companies deliberately tend to calculate adjusted EBITDA to make their P&L at the EBITDA level positive and create a positive impact in the minds of the investors. And that is something we need to understand in case of adjusted EBITDA.